my screen right now.
All right, perfect. We just wanted to introduce ourselves. My name is Annie Cantalis. I'm here with Emma Vandelander. And we just wanted to introduce everyone to John. Thank you again for taking the time to share this presentation with us. And I will let you take over.
Great. Annie, and how long is this scheduled for?
1 hour.
1 hour. Okay. And I do see, I believe there's a place where people can ask questions along the way. So I'll take a look every once in a while. If you need to stop me, and I'll try to answer the questions as they come up.
All right, perfect. All right, thank you.
So thank you, everyone. Some of you may have been at a presentation I did for the Texas Realtors Association with my colleague Jill Mazer from Engineered Tax Services back in the fall. And Annie asked us to just update the presentation a little bit, focus on Texas, and talk a little bit about opportunity zones. So I wanted to just introduce myself again. My name is John McElwee. I'm the CEO of Engineered Tax Exchange. We're simply in the business of trying to lower tax on behalf of investors and to find alternative capital for developers and or business owners, operators, with a focus on real estate and renewable energy. A lot of that product, of course, naturally is being developed in qualified opportunity zone areas right now. So this presentation is timely. All right, so I changed the objectives a little bit from the previous presentation, really just to talk more basically about qualified opportunity zones, what they are, what the legislation is, and how it came about, and then just a simple overview of the tax benefits for investors. Then we have a simple map of the U.S., a map of Texas. There are 628 designated qualified opportunity zone areas in Texas, and there are several sources where you can go and pull up interactive websites to see if a particular street location or building that you may be looking at on behalf of your company or investors is in a qualified opportunity zone. Just want to talk a little bit about this is not just for real estate. This is for businesses as well. And businesses have to operate inside a real estate area, but they can also qualify if structured correctly for the qualified opportunity zone investment as it relates to taxation. I'm then going to go over just simple investment criteria, focused really on real estate, some things that you should be thinking about before you jump in to an opportunity zone investment on behalf of yourself or your clients. Again, just simply don't treat this any differently than a regular real estate investment or a business investment. You really have to look at it from the ground up and see if the project is going to work on its own without the QOZ. And the last thing, just want to highlight a few of the differences between qualified opportunity zone investments and 1031 exchanges. Okay, so hopefully I'll hit all these points today, and if there's questions along the way, I'm going to try to answer them as best I can. Okay, so in terms of the legislation, this is very interesting, and again, this works well with the live audience, and since I can't hear anybody, I'll just play it out. But this legislation was literally 3 pages that was snuck into the 2017 Tax Cut and Jobs Act, initiated by the current administration. And it's very interesting in terms of how it came about. So the background is Sean Parker, who was the original founder of Napster and Facebook investor. I believe Justin Timberlake played his character in the social movie network. He came up with the idea, which was really an extension of previous enterprise zones and some other attempts to drive investment into economically deprived areas. So the 2 sponsors in the Senate of this legislation were Tim Scott, a Republican from South Carolina, and Cory Booker, a Democrat from New Jersey. They don't agree on much politically. Last 3 years has been very tumultuous, as we all know. This is one of the things that got done with the bipartisan support. So the objective here was to make any previous attempt to drive real estate investment or business investment into economically depressed areas more permanent. And that's how they came up with the 10-year hold period. And I'm going to explain that at length a little bit down the road. So each governor was given 30 days to come back to the administration with their designated areas. And they had to pick from the lower 25% of 2010 census tracts. 8,700 plus areas in the 50 states and the territories, including Puerto Rico, were ultimately designated. And as I said, 628 happen to be in Texas. So it's very interesting, and this is important. 2010, we're just starting to come out of the recession. And so we really at a depth economically relative to the previous 10 years. So a lot of these areas, now that it's 2020, the data that was used to select these areas is really old data. We're 10 years removed from it. And so a lot of these areas, even though they were in the bottom 25%, happen to be areas that were already seeing huge investment and turns from an economically depressed area to one that was on the uprise or swing. It's important to remember that, because when you're looking at these areas, I think you have to consider, is money or has money already gone into reviving a formerly downtrodden area? Okay, so this again, formally December 21st, 2017. We're 2 years and a couple weeks into this opportunity zone cycle. Effectively, you could make investment January 1st, 2018 to today, and this program runs until December 31st, 2047. So we've got another 28 years of life of this, and I'll explain that in a little bit as well. Okay, so this is something that's of critical importance, and again, we'll already give you some distinctions between this and 1031, but to be clear, the investment that gets the QOZ treatment has to be capital gains equity. You can have regular equity in a deal, in a real estate deal. Let's just take a $10 million example. You can go get $7 million of debt, put $2 million of regular non-QOZ equity in a deal, and $1 million of QOZ equity. All that means is, as it relates to tax treatment, the QOZ equity will get the tax treatment of the deferral, the reduction, and the elimination of taxation. The original $2 million that's equity, plain equity, will not. But you can have bifurcated structures that have a little of both and also have debt in them. The debt also does not receive any tax treatment that's favorable. It's just regular debt. But you can have it in a QOZ structure, of course. A lot of people were under the misconception that you had to invest 100% of cash capital gains equity into a project. You did not. You could invest $1 that came from cap gains. If you can get the other 99.99% of a deal financed, it still can be structurally sound as a QOZ fund, Qualified Opportunity Zone fund. So these cap gains can come from anything. Again, this is one of the distinctions between a QOZ investment and 1031. It could be from the sale of a business, sale of stock. You could have owned Apple for the last 10 years and want to take some chips off the table, sale of a house, sale of artwork or valuables. You might have your grandfather's old Ferrari and it's appreciated in value $5 million. You can take that $5 million and roll it into a QOZ investment. Okay. So I'm gonna skip to just the outline of exactly what the process is and how this happens in terms of original investment and then the tax benefit. You can see my kindergarten attempt to X out a 7-year benefit, which I'll talk about in a minute here. But let's just talk about the execution of moving capital gains into an investment. And again, different than a 1031, it does not have to be like-kind exchange. So real estate, stock sale, business sale, artwork sale can go into real estate and or a business. So you have to sell something to create that capital gains. And again, this is something, I'll just focus on this for a minute because there's a misconception here about generally about what has to be done in the timing. If you sell stock from a corporation in 2020 and the funds are in a partnership, you will have 180 days from year end to make that investment. If it's coming to you individually, so if you just have Apple stock in your E-Trade account and you sell it and it affects capital gains, you have 180 days from the date of sale to make that investment. Okay, so it's a little distinction here in this second slide here about the 180 days to make the investment from an individual's account where there's cap gains that are thrown into that account. It's different if it is an LLC or partnership, which most real estate ventures are, and of course corporations, et cetera. You'll have 108 days from year end. So going backwards in 2019, we have a leap year this year in 20. So that I believe the end date for gains that were passed through the corporation or partnership in 2019 will have to be placed into a fund by June 27th of 2020. Okay, so a couple things here, technical, and this is, again, we're focused on real estate. I know this is the Texas Realtors Association, so I want to keep the dialogue to real estate. But the fund that's established, and a fund is a little bit of a misnomer. A fund could be a single member LLC. It just has to be set up correctly with an operating agreement that specifies that this is a qualified opportunity fund. To set up the right structure to make sure everything is going to flow correctly from a compliance or administration is probably going to cost anywhere from $8,000 to $15,000 depending on the law firm you use. But it's a very important investment to make sure the structure is set up correctly, all the documents are in line, so that if you do get audited in 5, 10, 15 years, you have a trail or track record of setting up the structure correctly. It's very important. We speak to a lot of people that do not set up the fund correctly and think they can rewrite it, and it blows up deals. So just something to keep in mind. So the QOF, the Qualified Opportunity Fund, would buy real estate that happens to exist in one of those 628 areas, let's say in Texas. So the zone or the real estate has to be physically domiciled inside a qualified opportunity zone that has been designated. Okay. If you're buying an existing property, and let's say the purchase price is $1 million, you have to put $1 million plus $1, so $1 million and $1 into upgrading or refinishing that property. Okay. I'll go back to the $1 million. That is basically on your basis. So if the land is 300 of the 1 million, you would only have to improve the property $700,001 to make it qualify. Again, you got to think about the genesis of the rules and regs here. This was to spur investment into the opportunity zones. So the legislation is structured so that it's new dollars coming in, not just existing dollars that are there. And new dollars come in through new construction and or building improvement and or new businesses that create jobs and have potential longevity. So those top 4 items on this slide, it's critical that you set up the structure correctly from day one. Simply use capital gains, set up a qualified opportunity zone fund, invest in an opportunity zone designated area, and then if it's an existing property, match it dollar for dollar plus $1 in terms of improvement or ground up construction, you're good to go. So now let's go over the benefits. And the way I like to simplify and summarize the benefits are as follows. You have a deferral piece, a reduction piece, and an elimination piece. So what occurs is if you sell stock today, you defer paying capital gains tax on any capital gains through December 31st, 2026. So just 2 weeks shy of 7 years. So 6 years, 11 and a half months. No tax will be paid on that capital gains if you leave the money in an opportunity zone fund. And a fund could own real estate and or businesses. So that's the first piece, is deferral. The second piece is reduction, and this is where my fancy artwork comes into the X. You get the reduction of 10% on your tax bill, which is mathematically calculated based on a 10% step up in basis if you hold the property or business for 5 years in a QOF, in a fund that's in a zone. So let's take $1 million. If you would have paid $210,000 or 21% in capital gains tax on $1 million in 19, you will defer paying that $210,000, and after 5-year holding period, you'll get a 10% reduction in that $210,000. So it'll be $210,000 less 21. Okay, so what's the short math on that? $210,000 will be reduced to $189,000 that you will owe, and you have to pay that bill by December 31st, 2026. So you can see the X. There was a second step up in basis of an additional 5%, and that effectively went away 12/31/2019. Now there is talk of reviving that as an additional incentive, because it effectively took 2 years for the rules and regs to be worked out. We've seen indications that that is being discussed, but I wouldn't place any bets on that based on the current gridlock in Washington right now. So for right now, as it stands, the only step up in basis is after a 5-year hold. And again, if you run the math, that will expire December 31st, 2021. You still can make investments up until December 31st, 2026. But on January 1st of 2022, there will be no more step up in basis. You will still get the deferral piece for the remaining time to December 31st, 2026, and you'll get the elimination piece, which is what I'm going to talk about. So this slide, if you track it from top left all the way to right and then down, year 5, we've got the X through year 7. The next window here, this is critical. The tax is due tax year of December 31st, 2026. So the taxes will be paid by April 15th, 2027. So just want to make sure that's crystal clear. There is one risk here, which I don't think a lot of people talk about. If the cap rate changes, capital gains tax rate changes, you may end up paying more or less than the current 21% plus the 3.8% Obama tax if you're a high income earner. So just keep that in mind. Nobody has a crystal ball. I think it's going to be very difficult to get anything done, and obviously in the next year and a half, and subsequent to that, 4 more years of the current administration or a new administration with perhaps some change in Congress. The last time the tax code was revised to the extent that it was in 17 was 1986. So I think it's going to be challenging and difficult to change these, but a cap gains tax rate, that could change outside of the complete overhaul of the tax code. So just want to highlight that that is a risk, and we just want people to be sure of that. All right, here's where you get into the fun part. And I'm going to use real estate, but then I'm going to get into a business as well. This to me is the best aspect of opportunity zone investment, and I want to explain why. So if you hold the investment for 10 years, you pay no capital gains tax on any new appreciation. So again, I'll use an example. You invest $1 million into a real estate structure. The real estate structure is in a hot area. It grows. Your $1 million is worth $2.5 million in 10 years and a day. You have to have a sale or transaction to get the money out, and you have to do that before December 31st, 2047. But let's just assume you sell that property for $3 million, let's say, in 10 years and 1 day. In 10 years and 1 day, you will have paid, again, if the investment is made after January 1st of this year, 2020, you will have paid on $900,000 of tax, not the full $1 million. So you would get a 10% reduction in your tax, a deferral till 2026, and your $1 million investment that now is worth $3 million, your top $2 million of appreciation will be tax-free forever. So in that circumstance, in that example, you will have paid tax on $900,000. The top $2.1 million is tax-free forever. So what we do a lot when we speak in front of groups, and I believe I used a similar example at the Texas Realtors conference back in the fall, I get people to try to think about that and think about the impact that that's going to have on keeping all the money that you earn or all the value that appreciates in a real estate property. Well, what if it was a business? And this is where we try to provoke some thought here just to get people thinking in these terms. What if you had a business, a tech business that was in one of these opportunity zones and set up structurally correct as a qualified opportunity zone business? And let's just take the FANG stocks, Facebook, Apple, Amazon, Netflix, Google. Rough math, Netflix is the leader in the clubhouse in terms of appreciated value over the last 10 years. It's up roughly 45x, 45 times the original value. So I'll go back to that $1 million example. What if you put $1 million into a business like a Netflix that appreciated 45x over 10 years in 1 day? Sold the stock, sold the company in 10 years in a day. You would have picked up in that example 44.10x, $44.1 million tax-free forever. You will have paid tax on the $900,000, but that top $44 million, very, very interesting. The reason we bring this up, the real estate, yes, has to exist in a QOZ, but we try to even get real estate professionals to think about tenant mix, and maybe the owners can help set up a new fledgling business in a qualified opportunity zone and invest some capital gains to help the business get started that may be a tenant in one of their buildings in an opportunity zone and take some ownership of that company. And if the company is wildly successful, the real estate owners can see the same benefits of the business owners, operators, and investors. So just food for thought. Okay, I'm just going to check to see if there's any questions, and if not, we'll just wait till the end. Perfect. Doesn't look like anything is hitting the screen just yet. Okay. All right. So again, this isn't going to tell you much, excepting if you look at the big picture of the U.S. and you can see Puerto Rico down to the far right corner. Mostly all of Puerto Rico is an opportunity zone, and then Guam and some of the U.S. territories as well. So what you see here is the Northeast and Southeast are generally more densely populated than the West. So you have, more disparate or dislocated opportunity zone areas in the eastern half of the United States. In Texas, again, around some of the big cities, Houston, San Antonio, Dallas, Austin, you have more of a concentration of zones. Again, 628 in the state of Texas. But then in the rural areas, and this is something that's important I didn't hit on earlier, I'll just talk about this for a minute. This map is a great indicator. So Senator Cory Booker is from Newark, New Jersey, inner city kid. Senator Tim Scott is from rural South Carolina. So he's a country guy. He wanted to make sure that this was not just for the cities, that it impacted all low-income areas, all areas that were in that bottom quartile. So you see the structure of this map. A lot of the opportunity zone areas in some of the western, less densely populated states is purely a function of the math and where the poor areas are, where the economically distressed or deprived areas are. And the objective here, again, from both senators was let's drive new investment in real estate real estate improvement, and new businesses with new job creation, et cetera, into these areas. Rural, suburban, and city. All right, I'll go to the map of Texas right now. Again, if you just Google Opportunity Zone Map of Texas, 4 or 5 different interactive websites will come up, which will allow you to plug in down to the address, and it will tell you if it's in an Opportunity Zone area or not right out of the gates. So again, you see some parts up by Midland and Odessa to the north and the west that are bigger geographically, and a lot of sparsely populated areas or smaller areas in and around Dallas, San Antonio, Houston, et cetera. Some right in the city and some in the suburbs or exurbs right out. So I have a question here. I'm going to pop in. Okay, what was the website again? So there are several websites. I would just use a Google search. There's interactive maps, and various entities have them. I go right to the IRS now has a QOZ website, which will explain a lot of the rules and regs, but also will give you a link to an interactive website. And again, it'll start generally with the whole map of the U.S., and you can plug in Texas, it'll plug Texas. You can plug in Dallas, Texas, it'll plug Dallas, Texas, or you can plug in down to the street address. Okay, good question, and I'll see if I can find a source at the end of this dialogue. Oh. Another question. Oh, thank you. Thank you. Okay. All right, I'll go to the next slide here. Again, the investment is for building or businesses. So this picture is important, and just consider these windows are the businesses that happen to be tenants in a building. If the building is in a qualified opportunity zone, the business can be set up and qualify. I want to be clear about a couple things here. If the business is brand new, it needs to set up, as I discussed, the proper legal framework to set up as a qualified opportunity zone business first. If it does that, 100% of the equity can be maintained by the owners, the new owners, and qualify as an opportunity zone business. If it's an existing business and it moves into QOZB, the ownership, the current cap table would have to be reduced down to 19.99%. That's the maximum that an existing business could retain ownership. They'd have to get equity investors for the other 80% of the business. The reason is, again, one of the primary focuses of the law was to create new investment in real estate, either ground up or reconstruction, and new businesses into these areas. So it's not just a shift of businesses into an area, let's say a FedEx decides to move everything to QOZB. The current ownership would have to reduce ownership to 19.99% and sell off the other 80. This is important because at the Fortune 500 level, we are seeing strategically, again, a lot of the real estate assets that a FedEx and Amazon or another distribution company may own and operate, they are looking at QOZs, qualified opportunity zones. They'll make investments in these areas under a new structure and retain ownership. If it's an existing building, again, they'd have to sell off 80% of the business. But that's important. We think the real estate is driving qualified opportunity zone investment now, and I think you're going to see a dramatic shift in the next couple of years where a lot of the investment will be the businesses that operate inside the real estate that's inside a zone for the reasons that I mentioned earlier, where the upside potential with no taxation may be massive for tech companies, any type of high growth trajectory business, medical, et cetera. So anything that has the potential to go 10x or 100x, why would they not move into an opportunity zone? Okay, I'll just check. I think there was another question here. All right, so here's an example. What if an opportunity zone exists in a disparate area and you could purchase for $1 million and then you invest $1 million and improve the condition? You raise the rents, but the tenants can no longer afford. So they leave and tenants with more economics move in. Does that help the community or displace more people? Well, that's a very good question. And I think the answer to that is These have to work on their own merit. And this is not an objective to displace people from lower paying rents to higher paying rents. What you see, and I think this is interesting because this becomes not just an economic question, but a political one as well. And I think what you're going to see, some states already enact this, and I'll just give you an example of a project. We work with a developer in southern Florida City, and the city was in need of workforce housing for police officers, nurses, young doctors, city workers, etc. And so the city, on a $28 million project, gave the developer $7 million in grants to help keep the cost down, keep the rental rates down. So I think what you're going to see happen is the federal law is the federal law. You have states now, and even at the local or county or city level, that'll say, you know what, opportunity zones are great, but we don't want to displace 100,000 people. We want to give them better access to good living, quality living at below market rents, so they may offer grants or incentives to a developer to do that. I think you also see some politicians that will say, okay, we're going to take all this opportunity zone investment, but I hold the hammer on approving a development or not, and I'm not going to take 5 new shopping centers. I'm going to take 1 shopping center, 2 low-income housing developments, 2 market rent developments. So I think there'll have to be some balance. This really becomes a private-public partnership, and there's going to be a lot of nuance there. So I hope that answers your question. I think that's going to come down to the locality, and the locality is going to have to take control so this does not become a pure economic boon and incentive for the developers and the wealthy. It actually does what the purpose is, which was positively affects an area that does not have housing or doesn't have enough housing or needs better housing, low-income housing, and a mix of new businesses, et cetera. So thank you for that question. Okay. Let me move to what I'm just calling investment criteria, and I think this is important. It goes back to the basic tenets of real estate investment. I kept it to real estate, but you could apply this to business as well. And we tell people that QOZ rules and regs will not make a bad investment good. It may make a good investment better, and it will make a great investment with great execution and development or sponsor team excellent because of the values during the duration of the fund with the deferral piece and the reduction piece, but also the value on the back end that if in 11 years there's appreciation in the property, you're going to see no taxation on the appreciation. So just some things to think about. And again, this came up, and this is part of that last question. Well, if they're in the bottom quarter of census tracts from 2010, don't just rush into a bad area. Now, I'm in Pennsylvania. We have some areas here that are flourishing now, and they started flourishing back in 2010, 2011. They're going to be a good investment anyway. One is right by the University of Pennsylvania, Children's Hospital of Philadelphia, and Drexel University, right in West Philadelphia. 3 companies have committed, I believe, in the neighborhood of $20 billion over the next 20 years to regrow that area, and there's lots more development that already was occurring. It happens, the majority of it happens to be in a QOZ. So I would look at that investment first versus an area that needs a lot of help. You put a hotel in an area that has no other hotels and has no businesses to support it, it may struggle. So we tell people, stick to the basics, location, location, location. Look at the developer. Do they have track record? One thing that's important to us, did they start in 2011 or did they go through a downturn or two and start in 2001? There's a big difference. If a developer's been through a downturn, they may have better caution in terms of making investments and making developments that are going to work without the returns that are placed into a QOZ fund with the deferral, reduction, and tax elimination piece. The second part here, the compliance, fund management, and administration. I think this is very important for people to focus on. We talk to people all the time. I've got a background in asset management, as does one of my partners, managed billions of dollars in mutual funds for 30 years. We use companies that we will outsource that function to that have been doing fund management for 30 years. I talk to a lot of people that have a real estate project or a business. They're going to put it in the QOZ. And guess what? They've never invested in real estate before. They don't know the location as well, or just don't have track record, sponsored track record on development in that area or near that area. And they think they're going to run and maintain their own fund. And that, to me, is a recipe for disaster. There's going to be a lot of nuance into the fund management, the administration, and the quarterly and annual compliance, and we just want to make people aware of that. Technically, it can be very simple right now. It could be a single-member LLC with biannual, twice-annual self-reporting. That's what it is on paper. But I want to go through the paper real quick. The original legislation was 3 pages, literally, snuck in the 24th hour of the Jobs and Tax Act of 2017. First set of rules and regs came out in April of 19, or technically the second. The first one was an additional 24 pages. The second was an additional 174 pages. Now they came out with what they're claiming are the final rules and regs in excess of 550 pages in December of 19. So now you have close to 800 pages of rules and regs that started as 3. I'll bet you it gets closer to 2,000 before it gets reduced to 100. So that's our thought process, is this is going to get more complicated. And you do see some members of Congress that are asking for more accountability, again, which goes back to that previous question, to make sure that these investments are living up to what they're supposed to do, and the investment is going into the bottom quartile of census tracts across the U.S. So we just like to put some caution out here. QOZs sound great. They're not great for everybody. They're not great for every property. So please go back to Real Estate Investment 101 on behalf of your clients or yourself. Location, location, location. Sponsored track record. Would you make this investment without the QOZ benefit? If you can answer those questions, then yes, absolutely consider it. And then the management, the compliance, the fund administration. Who's going to do that? Who's going to answer the bell when the rules and regs change in 6 years, and who's going to be able to address the clients with that? Okay, I'm going to go to a couple Q&As here. All right, so one comment about, yes, supplement incentives will help keep affordable housing for low-income tenants. I think that's correct. And by the way, this is something else, and you'll see it in one of our subsequent slides here. Be proactive. If you're working with the developer, get them to go in and ask the city, ask the county for some grants, credits, or incentives that may help them with their capital on the development cost. If you go in with something that's needed in a depressed area where you need some support in order to make the economics work, then great. Go and ask. See if you can be like that one developer I mentioned that they got $7 million from their local city on a $28 million cap table, total capital table. So 25% of the cost paid for by the city to keep the rents down. So a lot of cities that need this, they have funds put away, or they will raise funds or increase taxes to raise funds for what's right and what their needs are. So keep that in mind. So Cassandra has a comment here. Area under transition in Dallas. Very expensive since it's close to downtown Dallas. Okay. Property taxes are going up for low-income earners. Will the high ad valorem taxes interrupt the NOI and subsequent cap on a QOZ if it is an area close to a downtown business center? It's a very valid point, and I'll simplify that because taxation if you're in a hot area, what's local government generally tend to do? They're going to tax it more. Okay, so yes, that is a risk. Here's something also that I believe the number, and I'll just be generic and rough with it, from CBRE, that QOZ designated real estate prices went up roughly 18% in 2019. So just because there's more activity and more interest, the prices went up. So that's something to keep in mind. So if you have inflationary pressure on the price of real estate plus increasing taxes, yes, they're both going to be detriments to the NOI. It's going to cost more. Your margin is going to get squeezed. And if you have an increase, on your pro forma, if you expect that the taxes are going to continually go up, yes, you're going to net out less money. All right, so Jill, my colleague, has a question here. If someone has a client with capital gains transaction, they sold a building, how can they find a fund to invest in? So again, I'll answer this question as simply as I can. We have funds, but there's thousands of developers out there that are looking for investment. I'd go back to the basics. Make sure you're comfortable with the developer. Maybe it's somebody in your area. Maybe it's you want to invest in low-income housing, or you want to invest in solar renewable energy development that happens to be in a QOZ. Find out what your investor's mandate is. Would always recommend to stick with something that they're comfortable with. We know a lot of real estate investors that don't want to give their money to another developer for obvious reasons. They're like, we can do it better ourselves, so we will find an investment in a QOZ. But if you have somebody that's looking, again, depending on their area, Jill, they can simply do a Google search. There's thousands of funds out there. Again, I would caution, just be careful. It's a little bit of new, uncharted territory right now, and just like anything else, some are going to be good, some are not going to be not so good. So just be careful in terms of if you make that investment. All right, I'm going to go to the next slide here. All right, so again, this is more of a technical element. I just wanted to keep it simple. Even the real estate, technically, you set up a QOF, a Qualified Opportunity Zone Fund, that then has an asset below it in a structure that is the real estate and or the QOZB. So just a couple things there. It's just think of a holding company, the fund, that owns the real estate or the asset. The asset could be the business below. Okay, so again, this could be stock, partnership interest, business property. A couple things to consider here. One fund cannot invest in another fund. So we have a lot of individuals that set up their own funds which is relatively easy to do and can be managed properly. It was for their own capital gains. But then they have 180 days to invest that money, their fund, directly into an asset. They cannot invest in another fund that then has a sub-tier of an asset. So it's just, I wish I had a diagram here to show everyone, but you just have to keep the fund, establish the fund, then the fund directly invest into an asset. Now, technically, you can have many assets in the below tier that a fund invests in 2 buildings or 5 buildings or 20 buildings. However, we tend to stay away from that just because we are believed that the single asset ownership is tighter and cleaner. If something happens to building 2, how's it going to impact building 1 in the investment there? So we kind of focus on single asset funds at the current time. Now, this is also important, and I'll go over some timing here. I don't think I have this on this slide or a subsequent slide, but once you make that investment, as I said, you have cap gains event, you have 180 days or 180 days from year end to invest the money into a fund. The fund then has 180 days to invest into an asset. So once you invest into the asset, you have to deploy 90% of that capital in that 180 days, excepting a couple safe harbor safe harbor elements. So if you have a written plan, so again, a lot of real estate takes longer than 6 months to build, develop. So originally it was 31 months to invest up to 90% of the QOZ equity into the assets, okay? So roughly 3 years. With the last rules and regs, and this is really for business, but there's some technical elements, and I'm still trying to get my arms around the legislation and the key points that are coming back from our attorneys shortly. I have a webinar on that next week. They've extended it to 62 months because there may be a downturn. There may be some things that impact why a business and or real estate got stopped or stalled or what have you that were out of the control of the developer. So technically now you have almost 5.5 years for your investment to be deployed. And it's very interesting. So it gives a lot more leeway in terms of time to developers and or business owners, operators. And here's something else to consider. It's 90% of opportunity zone assets must be in the property. This has changed in terms of, for a business, it's down to 70%. There are a few safe harbor provisions there as well. If you generate 50% of the revenue in a location that's in a zone, that will qualify. So there's a few nuances here about the 90%. You could keep 10% in cash all the time. You have that 3-year window and or a new 6-year window to invest the money. But there's a few safe harbor provisions which make that multiple a lot less, as low as 50%. I don't want to get into the details there. That's getting into the weeds. But if you just Google that, you'll find a lot of presentations like this that have some great information. So Form 8996, that is the form. I believe I have a copy of it on one of the upcoming pages. It was 1 page. It's now 2. Technically, the fund and the investors have to self-certify, just report 6 months after they make the investment and then at the end of the year. So then it turns into twice per year. So in June and December, the investors will have to fill out this form and send it into the IRS to show the progress of their investment and that it's still active and that they still get the deferral piece, et cetera. That's an area I think that's going to change. I think it's going to morph into quarterly reporting, and it'll be more stringent with an annual audit or something along those lines to make sure the funds are being administered correctly and that there's active compliance. Okay, here's the form. As I said, this is a draft. This is an old copy of it. It is now 2 pages. It's not that complicated, but basically it's just getting an investor to attest that they made an investment in a QOF and that it is still operational. They haven't pulled money from it, and that they're going to keep this investment for 10 years and a day. And while we're on this, and I know there's a couple questions, but I just want to talk about some of the nuance of the law and really talk about the flexibility of it. And I'll relate it to real estate as per that's what the audience is. We have about 10, 11 minutes here, so I'm going to try to speed up. But technically, let's say you work with a developer. You're in for $1 million. Somebody comes with an offer in 3 years for $3 million to buy the property. Oh, you're only in for 3 years. You have 7 left. Not so fast. You could sell that property, take the cap gains, still deferring, and from that date, you will have 365 days, 1 full year, to reinvest the money into another fund. So what that means is we get people to look at this as a giant 401k or Roth IRA. If you get a great offer, you're going to take the money. Then you just have to simply move the money into a new fund. And it could be your own, it could be another fund, to just hold the money for the balance. So 3 years, 1 year hold period for reinvestment. Now you're at 4. Now you only have 6 left. So the meter is still running. The clock is still ticking. And that's just something we want people to understand about the flexibility of this product. Okay, I'm going to skip to the next one here. 1031 comparison. The first sentence I think is most appropriate. Real estate dollars in the 1031 have to go back into real estate. art dollars have to go back into art. There's no requirement here. So again, as we said previously, your capital gains could come from any source: selling a house, selling a business, selling stock, selling artwork, selling furniture, whatever the case may be. If you can show and demonstrate that you receive capital gains, you can reinvest that capital gains. Again, you have here 180 days on a 1031. Technically, if it's pass through in a partnership or corporation, you may have 364 days plus 180 if you sell something on January 1st of a new year. So just keep that in mind. The other major difference, 1031, you can keep kicking the can down the road where you never have to pay tax until you decide, hey, okay, I'm going to pass this to my heirs or I'm not, and I'm going to pay the tax on it. You don't pass it to your heirs. You have to pay the tax, and you have to pay the tax with the appreciated value. In this circumstance, in QOZ investing, you pay the tax April of 2027, tax year December 31st, 2026. So you have to pay the cash at some point. But then after that, if you're staying the 10 years and a day or greater up till December 31st, 2047, you pay no tax on any new appreciation. Okay? All right, this is something you can Google something like this. I'll just talk very, very generically about this. The gist of this is when you're making an investment, you have to look at two things. One is, what if you didn't make the investment, you just paid the straight tax? And two is, all right, so you paid the 21% on $1 million, 210 grand. What would you do with the other $810,000? I'm sorry, $790,000 in that example. And if you invested it and got a 7% return, okay, great. Now compare that scenario to what if you didn't pay the 210 tax, you got it reduced by 10% after 5 years, and the $1 million was worth $3 million at the end of year 10. You picked up $2.1 million tax-free forever. So you have to do that analysis. We recommend. There's some models out there, some calculators. Talk to your CPA. Find somebody that can walk through the scenario. The short math is at 7%, you can see in the bottom row, it's roughly a 3% increase by investing in a QOZ because of the tax you defer, the reduction in your tax, and then new appreciation. You're picking up, in that example, $176 after 10 years at 7% versus $132 if you paid the tax. Okay, so big difference. At about 10%, it's about a 5% increase. 10% will yield 15 in a QOZ with the 10% IRR. 15, it goes up another 700-800 basis points, or 7 or 8%. So look at that, consider that in the math that you may do on behalf of your clients or yourself. Okay, got a few minutes here, and then this goes back to a previous conversation, and I just want everybody to be aware of this, specifically if you're in the real estate brokerage business. There's lots of other opportunities inside QOZs, outside QOZs, that we feel a lot of people do not take advantage of. And it requires some work. And it requires going to the local, the county, city, state, federal government, and seeing what grants, credits, and incentives may be available. So this, I'm not going to get into all the details here, but if you look at the math, this building was $10 million in terms of total capital, estimated $10 million in improvements. I'm sorry, $1 million cost, $10 million in improvements. But this developer was able to pick up 8.5 in credits, property tax abatements, TIFs, rent from cell towers, all this good stuff. This is a real example. So think about that. $11 million total capital. 8.5 is coming in terms of grants, credits, and incentives. And that's where we work with clients to figure out what we can do. We do a lot with tax credits, mostly historic, brownfield, and renewable energy tax credits. So we recommend if there's something that we can do with a real estate structure, take a look, figure it out, see if you can. It's not free money. There's a lot of work. But if you can pick up 20% of your capital table with non-traditional capital that does not cost you anything except the legwork to go through the process and maybe the legal or structuring fees, it might be worth the effort. Okay. All right, I'm just going to go over a couple of the examples that we have, and this is just to show diversity in our pipeline, and also to say again that this is happening coast to coast. Some states are doing more than others. Some developers are doing more than others, but I think it's really going to pick up some steam in the next couple of years. So we have a multifamily luxury high-rise in San Antonio. Again, what we like about this deal, it was going to happen anyway. The developers owned the property a few blocks from the Riverwalk. It happened to be designated a QOZ. So it's an area that has seen a lot of turn in an investment in the last 10 years, but back in 2010, it wasn't a fully developed area. It now is. We have a developer we did some tax credit deals with last year in Manhattan, in the Harlem section of Manhattan. Harlem back in the late 1800s was where all the Wall Streeters lived. Got a developer that has gone in, buying apartments, 6-unit, 5-unit apartment buildings, completely rehabbing them, but keeping the original structure, and therefore able to get tax credits. And in this structure in Upper Manhattan, I believe it's this one is near Columbia University. There's lots of QOZs around major universities. The biggest reason is you have 60,000 students at UPenn that don't make any money, 60,000 residents that might make 30,000 near them. Well, guess what? The average math is 15,000 per resident. So that's what skews a lot of the census tracts as it relates to universities. So that's a great development, looking for $12 million in QOZ equity. We have a developer, family office that owns 6 or 8 hotels. They're doing 2 in Western Maryland in the town of Frederick, second largest city outside of Baltimore in the state of Maryland, looking for $10 million of QOZ. We have an industrial developer also near San Antonio, Texas. They're doing five buildings, roughly $28 million capital, $9 million in QOZ. 30-plus years of experience, proven track record, and industrial is a hot area in San Antonio if you're from there because of all the cross-border transactions and all the shipping that comes from Mexico to Mexico, et cetera. Then we've got a senior care, and again, this to me goes to the altruistic nature of what QOZs were supposed to be established for, and that is, this is something that is well underserved. Senior daycare for veterans with PTSD, dementia, et cetera, older, aging veterans that don't have a home, don't have a place to go to get proper, adequate medical care. We're working with the developer right now, and similar to the previous slide, we're trying to see what other federal, state, or local grants, credits, or incentives may be available to put this a former hospital in a rural area and make it service men and women that have served this country that deserve great medical treatment. So this is something that we personally are investing in and going to get involved in, and we think it's a great cause, and we're looking forward to executing. Okay, so that's my information. If you just want to shoot me an email, I'd be more than happy to have a conversation with you, a specific project. We, just for full disclosure, we're not really looking for more projects right now. We're looking for investors. We've got enough projects on our plate, but more than happy to have a conversation and point folks in the right direction. Just about running out of time. I have one question here. So it is best to have an area and some letters of intent on properties in a QOZ before you sell an asset and create the fund. I would say yes. So you have a chicken and egg dilemma here. So, and again, let's think about what type of asset it is. If it's stock, you can call your broker tomorrow and liquidate. If it's a building, that takes time, right? And a lot of things fall through the cracks along the way. So it depends on the type of asset. But keep in mind, if that asset is in a partnership, you have time. So if you sold it today, you will have till June 27th of 2021 to make the investment. So that kind of depends what type of investment is. But yes, to have an LOI or to have a property locked up that happens to be in a QOZ, you need to structure correctly before the transaction occurs. You'll have to have the QOF established, and you'll have to identify that the asset, the real estate asset, is the one that you're going to buy. Hopefully that answers your questions. I appreciate everybody's time here. Hopefully it was insightful and informative, and thank you, Annie, for allowing us to make this presentation today.
Yeah, thank you so much. Just a reminder to everyone, this recording will be posted on our YouTube channel as well as our website. So thank you again, John.
Okay, thank you, everyone. We'll be in touch.
All right.
Have a great day. Bye-bye.